Hey, I was browsing Reddit the other day and I saw a post that stopped me cold. A user wrote, I'm trying to understand rental property deductions, but I feel like I'm leaving money on the table. It had hundreds of responses, and frankly, most landlords are leaving money on the table. They take the big obvious deductions, but they miss the strategic ones that actually create massive tax-free cash flow. In fact, I paid exactly $0 in federal income taxes on $50,000 in rental income last year. And I didn't do it by hiding money or living offshore. I did it by using the exact rules the IRS gave us in the One Big Beautiful Tax Bill of 2025. You see, most landlords hear $50,000 in rental income and they think they're going to owe the government $12,000 to $15,000. But here's what I'm going to do today. I'm going to show you the story of, let's call him Investor Dave. We're going to walk through his year, and one by one, we're going to use every legal deduction in the 2026 playbook to whittle this number down until the IRS has nothing left to tax. So listen, if you feel like you're leaving money on the table, then grab a pen, because if you want to stop tipping the IRS, let's get into the math. All right, let's meet Dave. So we have this individual investor here named Dave, and Dave owns 3 rental properties. Now, in 2025, those rental properties brought in $50,000 in rental income, right? So we got $50K right here. Now, Dave's feeling really good about this, right? He's got this $50K and his account looks great, but the tax bill is looming. So here's what we want to do. We want to start the countdown. Now, what is the first big deduction that Dave should be claiming? Well, that's going to be the big 3, right? Mortgage, interest deduction, property taxes, and insurance. Let's say you add all of these up and they equate to $22,000. Then that's going to be a deduction to Dave's $50K in rental income. So we'll put a deduction right there of $22K. So that brings us down now to $28,000 in income. Now, if you bought a property or you refinanced a property in 2025, don't forget about any loan origination points you paid to buy down your rate. If you did a refi or a purchase in the last 24 months, those points, they can be hidden gold. And a lot of people, oftentimes our tax department tells me, misses this opportunity. You can often amortize them over the life of the loan, creating a steady, silent deduction every single year. Okay, or if you're refinancing the loan, you can take all of those in the year of the refi that you have not yet claimed. All right, so anyways, we're halfway there, okay, but this isn't the easy part. Now we have to look at where the strategy is to get to 0. So the next thing we need to look at is that Dave had some maintenance, right? He had to replace, say, 2 water heaters and fix a fence. So the total cost of all that was $4,500. Now, here's the best thing about rental property. You have what is referred to as the de minimis exemption. So when it comes to writing off expenses, you have to look at what is referred to as a repair versus an improvement to the property. Now, most things are pretty straightforward there. Like if you extend the useful life of an asset, let's say I replace the entire roof, that's going to look like an improvement, and you cannot deduct it in the year in which you replace the roof. But if you do a small section of the roof, then you can classify it as a repair. Now, the IRS has a safe harbor here. And the safe harbor states that if you spend under $2,500 per item or per thing that's done to the property, it automatically falls under this de minimis category and you can write it off. So in Dave's instance, where he bought 2 water heaters, what you definitely want to do is buy those independently. So let's say he spent $1,000 each on both of those, and then he spent $2,500 to repair the fence. That's going to bring us in right under the de minimis exemption. So what does that mean to Dave? He's going to have another $4,500 deduction here, which is going to bring this down now to $23,500, right, of taxable income. Now, of course, Dave has to get behind the wheel. He has to drive to his rental properties. And let's assume that Dave, he's a good steward of his real estate. He's checking on his properties, and he drives 2,000 miles a year to inspect the properties, repair them, trips to the hardware store even to just go and converse with his tenants. Now, when Dave's driving for his rental property, he needs to keep a mileage log because the 2026 IRS rates allow you to deduct 72.5 cents per mile. So based upon Dave's driving, what is that going to equate to? Well, that's going to be $1,450. So let's throw that up there for Dave. He's going to get $1,450 $450 just in the mileage deduction of driving around for his properties. So that's going to lower this down now to, what does that look like? $22,050 here. All right, so now we got $22,050 left that we have to work with. But Dave also has one property he owns out of state. It's not uncommon. Most real estate investors look for the deals in the market. Doesn't mean it's going to be in your local backyard. So assume Dave had to fly out for a 3-day property audit. Went out to check on his property, and his airfare, his hotel, and his meals while he's on his business trip, because that's what this is when you go to check on your rental, that's another $2,500. So we're going to give Dave an additional $2,500 here for his travel. So now we're really starting to whittle this away. So now we're down to $19,550. And Dave, I may have to move to more whiteboard here because we're going to keep working away at this. Now, Dave's a smart investor, and this is something you have to be aware of here, and most people miss this as well. He knows that asset protection is really important. So when Dave bought his rental properties, he wanted to make sure that he's protecting them the right way. So Dave put all of those properties into separate LLCs. So Dave had a structure where he had 3 limited liability companies set up like this. And in each of those LLCs, he had one property. Well, Dave also is a good steward of educating himself, and he's been watching my YouTube channel, and he heard about the power and the benefits of using a Wyoming limited liability company. So he established a Wyoming LLC to hold these 3 LLCs. So he set up, one of these that I talk about all the time, and the benefits. You can catch my other videos on this topic. So let's assume the setup for that Wyoming limited liability company, Dave paid $1,500 to set up that Wyoming LLC. Yeah, we're running out of room here. So that's going to bring Dave down now to $18,050 of remaining income that he still has to work on. Now, most real estate investors that I've worked with and I've met many times start by attending some course to teach them how to invest in real estate. Let's say Dave spent $2,000. I know that's really light because I've seen what some people invest in themselves in order to learn about this, but I'm going to make it simple. Let's say he invested $2,000 for a tax strategy course and he attended a real estate seminar. Now, since Dave's already in the rental business because he has rental properties, the IRS allows him to deduct that expense as an education expense that is part of an ordinary and necessary for keeping his business competitive. So in this instance, if Dave spent $2,000, let's just go back up here. We had the 18,050. Let's take $2,000 off for Dave. For that expense, that brings us down to 16,050. All right, now, it's time to bring out the heavy guns here. Now, this is where real estate can really have a major impact on your tax liability. So the move that separates the amateurs from the pros, Dave did what most real estate investors I always encourage to do with their properties, and that is run a cost segregation study on one of his new acquisitions. Now, instead of waiting 27 and a half years to depreciate your entire property, what you can do is you can run a cost segregation study and you look at 5 and 15-year components to your real estate, like let's take this one right here, and then you can compress down that time. All right, now I have plenty of videos on this topic. If you just search cost segregation on my channel, if you're not familiar with this, you'll see how it works. But this is a heavy hitter to reducing your taxes, because what it allows you to do is take things like your flooring, your driveway, your landscaping, your sinks, your HVAC system, and you can depreciate them on a much quicker time frame. Plus, if you use bonus depreciation, it becomes a 100% write-off. Now, Dave was able to take advantage of that because of the new tax act. And so on that rental, if we added all that up, he produced for himself a $20,000 paper loss. Now, this is really light. Generally speaking, I've seen these be much higher than this, well up, sometimes up into the high 6 figures, depending on the value of the asset. But let's assume he had $20,000 then that he was able to take. So we'll just knock off $20K off of that. And that puts us at negative $4,000. Okay, you see how fast this works out if you're a real estate investor? Dave lost now $4K. So he put $50,000 into the bank. He spent a lot of that, but he's able to deduct a huge portion of that by keeping track of all of his expenses and tying them back to the business. So this passive loss that Dave has here, he can carry it forward to next year, or he can use it to wipe out other income that he has. Now, if Dave was focused on real estate full time, where he had a spouse that was working in real estate, maybe Dave could even qualify as a real estate professional. Or another strategy we could look at is taking that rental right up here that he just bought this year, making it a short-term rental. And if we show that he materially participated and spent 100 hours, and that's more than anyone else on that one property, well, in that instance, what we'd be able to do is take this loss here and offset it against W-2 income that Dave may have. You see, when it comes down to real estate and maximizing the deductions, what that Reddit poster didn't realize is that there's a ton of opportunities there. This is how you pay $0 in taxes on $50,000 in rent. And you'll see there's a lot of people out there sometimes that will discuss, oh, you move to Costa Rica, do this strategy here with an offshore account. You don't need to do anything like that. The 2026 tax code gives you the benefits. You just have to know how to find them. In fact, if you want to see an exact checklist that Dave used, I've put together the 2026 landlord deduction master list. Now, there's a link in the description below. It's the same list I've used for my own properties. All you need to do is click on the link and you can grab your copy today. And then I'll tell you what, stop giving the IRS a tip. Start putting that back into your own pocket. Listen, if this visual breakdown helped you, hit the like button and subscribe for more 2026 wealth building strategies. All right, everyone, take care.